Hello everyone and welcome back to the channel. Today we are diving headfirst into the biggest financial debate dominating the headlines and the market sentiment right now. Will the US Federal Reserve cut the interest rates in December? The anticipation is palpable. The data is conflicting and the global markets are in a frenzy, reacting to every whisper and the economic report. For weeks, perhaps even months, the idea of a rate cut by Federal Reserve felt like a distant dream. But recently, something has shifted. A significant wave of new economic data has fueled a dramatic increase in the market expectations, pushing the probability of a December rate cut higher and higher. This isn't just a niche discussion for economists, it's an impact on your investment, the cost of borrowing, and the trajectory of the global economy. So, is this a wishful thinking from an eager market, or is the Fed truly being concerned into the policy pivot? Let's break it down. To understand this frenzy, we need to look at why December has suddenly become the focus. Historically, the Fed moves cautiously. They don't like surprises, but the recent economic indicators have been sending some undeniable signals. The primary driver is the inflation. For a long time, inflation was the Fed's public enemy number one. We saw aggressive rates hikes aimed at bringing the pricing down. But the latest inflation report, both the consumer price index or the CPI and the personal consumption expenditure or the PCE, has shown consistent sign of cooling. While not yet the Fed's idea of 2% target, the trend is clearly downwards. And perhaps more importantly, the rate of change in disinflation has been significant. This is giving the Fed some breathing room they haven't had in years. Beyond the inflation, we have seen some softening in the labor market. While still robust, the monthly job reports have shown a slight deceleration in job creation, and in some sectors, losing a wage pressure as well. This isn't a sign of collapse, but it is suggesting the economy might be cooling just enough to alleviate the concerns about overheating, which could reignite the inflation. A Goldilocks scenario, if you will, not too hot, not too cold. When you combine these factors, cooling inflation and softening labor market, the narrative of a rate cut begins to solidify in the market's mind. The aggressive tightening cycle might have done its job, and now it's time to ease off the brakes before the economy slows too much. Now let's talk about the market's reaction. This isn't just academic speculation, it's tangible. As expectations for December rate cuts have risen, global markets have responded with a massive rally. We have seen significant gains in stocks, indexes like the S&P 500 and Nasdaq. Why? Because the lower interest rates generally translate to cheaper borrowing cost for companies, which can boost profits. They also make future earnings more valuable in present terms and enticing the investors. Tech stocks in particular often benefit disproportionately from the lower rates. But it is not just equities. The bond market has also been seeing huge benefits because of this rally. The bond price is rising and yield is falling. For individual investors, this means prospects of lower mortgage rates and cheaper loans for cars, businesses, and more. Even commodities like gold often see a boost from the rate cut expectations. Gold is a non-yielding asset, so when the interest rate falls, the opportunity cost of holding gold decrease, making it a more attractive safe haven. The US dollar is another key player. When the Fed cut rate, it can make the dollar less attractive relative to other currencies, leading to depreciation. This can have ripple effects globally, impacting trade and the competitive pricing for the US exports. This market rally isn't just a happy coincidence, it's a direct reflection of the investors' pricing in future monetary policy. They are effectively saying, we believe the Fed is about to pivot and we are positioning ourselves accordingly. This creates a self fulfilling prophecy to some extent, as market sentiment can influence economic activity. The question is the market getting ahead of itself, or is it accurately predicting the Fed's hand? This brings us to the Federal Reserve itself. While the market is buzzing, the Fed's public statement has been, as always, carefully measured. Fed Chair Jerome Powell and other FOMC members have consistently reiterated a data dependent approach. Powell has often stated that they are far from declaring victory over inflation and that a premature pivot could undo all their hard work. They are still members on the Federal Open Market Committee (FOMC), who expresses caution, highlighting potential risk of inflation reaccelerating or arguing that the labor market is still too tight. This is the ongoing debate mentioned in our title as well. It is not a unanimous decision, and differing viewpoints are healthy for a central bank as well. They are acutely aware of the risk of causing recession if they hold rates too high for too long, but they are equally wary of the cutting too soon and allowing inflation to flare up again. It's a delicate balancing act, like navigating a ship through a narrow strait. So while the market is betting big on the December, the Fed's official stance is one of the continued vigilance. They want to see more consistent data, more definitive proof that inflation is truly tamed and that the economy can withstand a slight easing without reigniting price pressures. They will be looking at not just headlines numbers but also at underlying trends and various components of inflation. The December FOMC meeting will be absolutely critical, not just for the rate decision itself, but for the accompanying statement and economic projections that will give us a clear picture of the Fed's outlook for 2026. So where does this leave us? The rising market anticipation for a December rate cut is real, and it is backed by some compelling economic data. The global market rally is testament to expectations. However, the Federal Reserve itself remains cautiously optimistic, prioritizing their inflation fight and emphasizing a data-dependent approach. For investors, this means staying informed is more crucial than ever. Don't simply react to headlines. Understand the underlying data, follow the Fed's communication closely, and consider how a potential a rate cut or a surprise hold on the rate might impact your own financial goals. Whether December turns out to be the date for a rate cut remains to be seen. But one thing is clear, the debate is at its peak and the financial world is holding its breath. So friends, what are your thoughts? Do you think the Fed will cut the rate in December, or do you believe they will hold it firm? Let me know in the comments below. And if you found this video helpful, please give it a thumbs up, subscribe to the channel for more in-depth financial analysis. And thanks for watching, thanks for joining live, and I will see you again in the next one.